My name's Ronan Smith. I'm the Chief Operating Officer of the Trinity Student Managed Fund, and I'm delighted to welcome you all here this evening for our fourth and final speaker series event of the year, where we have the great pleasure of welcoming Mr. MOHNISH to Trinity College Dublin. This event is going to be recorded, so please put your phones on silent or turn them off. We'd really appreciate that. An event like this takes a lot of effort to put together, so I want to thank, firstly, our executive teams, operations teams, and the investment managers involved. I also want to take this moment to thank our Chief Executive Officer, Ms. Mary-Louise O'Callaghan, for all her effort and leadership throughout the year. It's something we don't acknowledge often enough, so I just want to personally thank her for all her hard work. We're absolutely thrilled to be able to welcome MOHNISH to Trinity College Dublin this evening. He was just stopping by. He was in India at an investment conference, so he was very good to spend the evening with us before he heads back to the States. MOHNISH's success isn't bounded within one arena of business and finance. As an entrepreneur, he started an IT consulting business with $100,000 of capital and sold that business for $20 million. As an investor, he started the MOHNISH, the PABRAI investment funds with $1 million of capital. Those funds now have over $800 million. And as an author, he has penned two fantastic books, Mosaic and The Down Investor, two books I really do encourage you all to have on your bookshelf. And as a philanthropist, he founded the Dashkana Foundation in 2005, which helps students in impoverished circumstances who are really gifted to get the opportunity they deserve. So ladies and gentlemen, please help me in welcoming Mr. MOHNISH PABRAI.
Thank you, Ronan. So this Irish guy, John, goes into the same pub every day, and he orders 3 pints of Guinness, and so the bartender asked him, why do you order 3 pints of Guinness every day? He says, one's for me and 2 are on behalf of my brothers at home. And then one day he comes in and starts ordering only 2 pints instead of the 3. So the bartender asked him, how come you switched to 2? He said, I've given up drinking. So anyway, pleasure to be here. And also want to thank Ronan and the Student Managed Fund. I think they've done a great job, and so thank you very much for putting this together. It's a pleasure and honor to be here. I used to come to Ireland quite a bit about 30 years ago, mostly to Shannon. So I've seen a bit of the countryside, and once in a while I take the train to Dublin. So it's always a pleasure to be here. It's a great country, and obviously nice to speak to you. So I have a few slides I'll run through, and then I think what I'm hoping for is more of us talking about what's on your mind. So we can, when we do our Q&A, you can ask questions related to the slides, but pretty much other than what I'm buying right now, everything is fine. So we'll go through that and then take it from there. So this book called Bull came out, I think, in 2001 or 2002, about 17, 18 years ago, and actually was recommended by Warren Buffett. It's a really good book to read, written by Maggie Maher. And what Maggie had chronicled in the book was she had looked at stock markets, and specifically in her case, she looked at the U.S. market over a very long period of time, like almost a century. And what she noticed was that, we are told that, for example, that if you had invested over the last 100 years in the U.S. equity market, you would have averaged about 9% a year, which is a pretty good return after inflation and such. But that's kind of a half-truth in the sense that markets go through very long periods where they do nothing, and equally long periods where they can be just spectacular returns, way above the 9%. And specifically what Maggie had honed in on in her book was, so this is the chart of the Dow going back 1898. And so if you look at it, for example, when we, one period we can look at is like, for example, 1965. So the Dow was, about 870 approximately in 1965. And in 1981, it was again at 870. So, we went through a 17-year period, absolutely flat. I mean, it wasn't flat in terms of the market going up and down, but at those two endpoints, it was completely flat. So you didn't have a great result as an investor, even if you were very long-term oriented. And in that period, 65 to 81, the US economy grew a lot. So it wasn't like that the economy was in a bad shape or anything like that. Then you look at another period, which is 82 to 99, and the Dow went from less than 900 to more than 12,000. And the annualized return then was well above 9%. We were doing about 15% a year. And so that kind of was quite a spectacular period in terms of returns. And probably towards the early part of 2000, there was a lot of euphoria, especially because we had at that time we had all the craziness with the dot-com boom and the dot-com bust and so on. But even non-tech stocks got quite euphoric, and then if you fast forward from there, let's say from 99 or 2000 until around 2012, we're again flat. Pretty much there's no movement, and of course it's not exactly flat because you went down a precipice in 2008 and 09 and then came back. But basically the 12-year period, we didn't have much to write home for equity investors. And then more recently, it's been kind of somewhat similar to the 9% average and such. And this is not a phenomena that is limited to the Dow or to the US. It's actually a global phenomena. So as you look at different markets at different times, and they don't obviously go through the highs and lows at the same times. They go through it at different times. But the reason we get these, and Maggie chronicled, there's a reason why we get these, specifically let's look at 17-year cycles, is about the length of human memory, if you will. So in 1965, the stock market was a very euphoric place. Valuations were stretched, and we had the Nifty 50 and all that sort of thing getting going at that time. And by the time you got to 1981, people would look at you funny if you recommended investing in equities. In fact, Business Week ran a headline at that time. In fact, they had to cover the death of equities. Basically it's done. There's no point investing. And generally when people are extremely bearish and they give up, they're just not interested at all, that sets up the foundations for a pretty significant bull run from there. So reason we get these cycles is that markets vacillate between extreme euphoria and extreme pessimism. And the reason they do that vacillation is because they're human-driven. And humans vacillate between fear and greed. And so as long as humans are driving the buying and selling of different asset classes, we will continue to have these cycles. And of course, as an investor, the value investor myself, this is kind of a weird kind of presentation for me to make because I don't pay any attention to macro anything. All my attention goes on figuring out a business and then figuring out what that business is worth and what that business might be worth in a few years and whether it makes sense to invest in it or not. And generally speaking, it's hard enough to figure out the future of one business. I think it's almost impossible to figure out the future of markets because that's just too complicated. But it is somewhat helpful, I think, to just understand a little bit about where we are in these cycles in different cases. And in my own case, PABRAI Fund started in July of '99, and I realized when it started that there were many elements of a bubble when I was getting going. And I also realized at that time, even though Maggie's book was not out then, that it was a terrible time to start a fund because I knew I'd be facing pretty significant headwinds because of these. But also the thing is, the market was really interesting. So March 9th, 2000, I think, is when the NASDAQ peaked. It peaked at a little over 5,000. And the day the NASDAQ peaked was the exact same day that Berkshire Hathaway hit a multi-year low. And literally people were pulling money out of Berkshire Hathaway and putting it into pets.com. And so that you had that phenomena going on. And so actually what I found when I started investing professionally was that there were lots of great opportunities, even in this overheated market, as long as you didn't participate in the euphoria. So all the money was going into a very small sliver of equities. And that small sliver was, going crazy. And so there were lots and lots of opportunities on lesser known names, and people thought Warren had lost it, he wasn't in technology, and all that sort of thing. And so actually the first year in PABRAI funds, for example, we were up north of 70%. And for the next several years after that, 2002, 2003 onwards, we actually did all positive returns, I think north of 15, 20% a year for a few years. And part of that was because I just focused on stock picking. And I had very little capital, and it was easy to find a few good ideas. So that worked. And but I think what was happening at this time, and I think if you take an example of something like Coca-Cola, for example. So Coke was selling in, I think, the early 2000 at something like 45 times earnings. And recently, it's been at about 15 times earnings. So basically, if you invested in the Coca-Cola company in 2000, from then till now, you've made like 2% a year. Not a great investment. The business has done really well. No problem with the business. But anytime you're buying at 45 times earnings, and eventually that earnings number comes down to 15 times, you're going to have not such a great experience. So it's not enough to just buy great businesses. Price matters. And I remember I think it was in 2000, right when my funds had just started, I think been about a year or so, that one of my investors had been an employee of Microsoft. And in fact, he was one of the very early employees of Microsoft. He had retired from Microsoft, but with the stock options, et cetera, had done really well. And so he told me, listen, Mohnish, if you're ever coming to Seattle, I can introduce you to a bunch of Microsoft guys, and many of them may have an interest in putting money with you. And so I told him, as a matter of fact, day after tomorrow, I'm going to be in Seattle. What a coincidence, And so he said, oh, yeah, come on down, So, of course, at that time, I was, very happy to be raising assets, especially with someone saying, I've got a bunch of customers lined up for you. And so I visited Microsoft headquarters, and I met a whole bunch of folks, and some of them actually were, first 60 employees in the company and such. And of course, a number of them became investors. But I remember telling them at that time that, and I think they just thought I was some cheesy salesman saying this, but I told them that it was a terrible idea for them to be holding Microsoft stock. And they just thought, well, how stupid is this guy? Because all Microsoft had done until then had gone straight up, 30-40% a year for a long time. And the market cap, I think at the time was over 600 billion. And I think eventually, it went all the way down to under 200 billion. And then, of course, now recently it's come. But even with Microsoft, from 2000 almost till just maybe 2013 or 14, you would have had almost no returns. And in fact, you would have had a rough ride because you would have gone down and then come up. So, and that wasn't even a dot-com, real business with real cash flows, but with very euphoric pricing. I think in 2000, Microsoft was making something like 10 billion, around 10 billion a year or so, and trading at 600 billion, and that math doesn't work so well. So if we look at the S&P over the same period, similar story, where we again go through these periods of flatline and such. So basically, if I just go back to the Dow for a second, 1965, extreme euphoria, 1981, extreme pessimism. Then you again get to 1999, 2000, extreme euphoria, and so on and so forth. And that will just continue. And if we look at it in terms of some other markets, I mean, the Nasdaq is a great example. Went through a 20-year period from 1980 to 2000, doing 20% a year. And then the ride from 2000 was quite a brutal ride because you went from 5,000 to 1250, 75% decline on a major index. This is not one stock going down, there's a whole index going down. And so we went 16 years, so it took the Nasdaq 16 years to come back. And that's with having Amazon and Apple and Netflix and all these high flyers in there. Even with all of that, it took 16 years to come back. And then more recently, we've had a somewhat better ride. So we've had a similar situation. If you look at the Indian market, the Sensex, which is the kind of like the Dow in India, the Indian government actually liberalized the economy in 1992. Basically, India had a huge balance of payments problem, and they were running out of foreign exchange and such. So they opened up the economy. But even though there was a lot of growth that came from 92 onwards, for 12 years, the market was flat. And so we see the same kind of pattern of flat and then doing well. The German DAX, similar story. In fact, last 11 years is completely flat, no returns. And the Japanese Nikkei is interesting because this was the mother of all bubbles. So 1990, the Nikkei peaked at 40,000. And here we are, 2019. It's been 29 years, and it hasn't come back yet. In fact, it's at about 50% of the peak level. So if you just think about even a company or an economy growing, 2-3% a year, 4% a year, some not that high a number, maybe 3% a year. I mean, in 25 years, things should double. Rule of 72. Here we are down to 29 years, and we have a negative return. And so 1990, Japan had a number of incredible bubbles. And one of the bubbles it had going on there was the mother of all property bubbles, real estate. In fact, the Imperial Palace in Tokyo was valued at the time more than all the real estate in the state of California. And in fact, when I read that, I found that incredulous. I just said, that's not possible. So I actually went and studied it. And I live in the state of California. I mean, we have phenomenal coastline, thousands of miles of coastline, and we have incredible real estate. And to have one small palace in the middle of Tokyo, and it actually exceeded the value of all the real estate in California, is just stunning. And of course, like our man in the pub with the 3 pints, the bigger the party, the greater the hangover. And they're not done yet. The hangover continues after 29 years. And so Japan is kind of interesting because the property bubble seeped into the equity markets, and it just took a long time. And in fact, if you look at the Japanese market today, the equity market's probably amongst the cheapest markets in the world. I think the one thing that dissuades me in terms of just generally looking at Japan is there is a culturally, Japanese companies do not put shareholders first. So usually employees are first, and then there are various other stakeholders that come after that, and shareholders are somewhere in the bottom. And so you find a lot of Japanese companies trading below cash. So if you just look at net assets, net current assets, and subtract all liabilities, and look at the market cap, basically they exceed market cap, which is basically Ben Graham era. But the issue is that the companies are not willing to let go of the cash, and so in some ways the cash, from my perspective, is an illusion, because to unlock that value, that cash needs to come out, and I don't think it's coming out. So that's an interesting market. Another one that is, I think, probably one of the most interesting is the KOSPI in South Korea. And so if you look at the KOSPI, actually, even though you see this 19-year period and then 2 years and 8 years, but if you take the entire period from 1989 to 2019, which is 30 years, basically what has happened in 30 years, the KOSPI has gone from 1,000 to 2,000. So over a 30-year period, it's about a little over 2% a year. And if you think of Korea going back to 89, I mean, this is before the rise of Samsung and before the rise of Hyundai and before really the rise of South Korea as we know it today. So incredible growth, huge economic growth, and nothing in terms of equity returns. In fact, I'm making a trip next month to Seoul and Busan, and basically I'm visiting a few businesses. I have one investment in Korea, but probably one of the most fertile hunting grounds. Of course, the impediments are the language is an impediment, culture is an impediment, and such. But plenty of stuff trading at 3 times earnings and that sort of thing. And so if you want to go fishing where the fish are, I think this is where the fish are. And so these are some of the thoughts I just wanted to share in terms of and with equity markets we usually cannot tell for the most part where we are unless we get to extremes. When we get to extremes, then it's obvious. Like I think you can look at Japan and you can tell it's a cheap market. You can look at Korea and you can tell it's a cheap market. When I look at the United States, all I can tell is I can't find much to buy, but it doesn't mean things are overvalued. Just be they're either fully valued. Even if they're slightly above fully valued, they could grow into that. So I don't quite see signals one way or another in most of the markets. And most markets at most times don't get to extremes. They get to extremes at like once in 15 or 20 years and such. And then we can take advantage possibly if again within like the fact that Korea is cheap, all that means to me is, hey, maybe spend more time looking at Korean companies, but doesn't mean that I can obviously make an investment. If we can find businesses that we can understand within circle of competence, they're cheap and so on, then I think can look at them. So those were some of the comments I wanted to share with all of you in terms of formal remarks. And I think maybe if you have anything related to this or anything else on your mind, we can certainly talk about it. And so we have a couple of mics, so you just ask for a mic. And if you could just tell me or tell us your name and what you're studying and so on, then ask the question, that'd be great. Or if you're working someplace where you work, that'd be great too.
Hey Mohnish, glad to have you here. My name's Owen. I work in research in kind of options. I was just wondering, you're talking to Microsoft investors that are coming on board, possibly as limited partners. How do you balance that with value investing as behaviorally more longer term, and then you have these more tech-based people that have made a lot of money? How do you balance kind of the permanency of capital with your investment time frame?
Yeah, well, that's a good question. Actually, the Microsoft crew that has been with me, I think now they've been with me for like almost a couple of decades. I haven't seen them exhibit any behavior that would be of the kind that you're suggesting, in the sense that I hardly ever hear from them. And maybe they've forgotten they have money with me, who knows. And actually, no, they have not been trigger happy, and they have not, in fact, some of them have consistently added over the years. I think many of them probably just see, they see probably my world as somewhat a weird world, if you will. But they probably also see, one thing that has played out is what I told them came to pass. So I don't rub it in their face by telling them I told you so. But I think they probably just see it, hey, this is a kind of different asset class than what I have most of my money in. And that's fine. So I have not seen them really exhibit any type of short-term type thinking. They might be doing it in other parts of the portfolio that I don't see. But that's been the way it is. But I also don't think any of them took my advice and unloaded Microsoft then.
Paul McMillan, I manage my own money. My question is around, from the beginning, how your process might have changed in any way. If maybe you could talk a little about some of the challenges you've had in the journey thus far, and realizations, et cetera, you've had.
Sure. Yeah, I think one of the things I really like about investing, and specifically value investing, is that there are a couple of things. One is it's the broadest of any discipline that you can be in, because any business you might look at, it kind of touches on, the factors that can affect the future of a business touch a number of different disparate disciplines. And the second is the learning never stops. So it's kind of continuous learning, if you will. And so I think as I look at, I think PABRAI Funds is almost 20 years old, and then before that, about probably 5 years before that, I was managing my own money, the value style, if you will. And so this 25-year journey, there has been a lot of learning. If I look at MOHNISH as an investor 25 years ago versus today, there's plenty of commonality in terms of core principles. The core principles don't change, but there's a lot of learning and especially a lot of learning from the mistakes. So for example, if I look back, and especially if I look back at the areas I've had trouble in, right? One of the big areas that I've had trouble in is levered institutions. So I've had a few picks go to zero because they were levered, and sometimes it's been leveraged companies. So what I've learned is that for whatever reason, I tell myself, Mohnish, maybe you just don't understand these things, so just stay away. Even if it looks good, just stay away. And actually, if you study Berkshire Hathaway, for example, So one of the things about investing is that John Templeton used to say that the very best investment analyst will be wrong 1/3 of the time. And so even if you look at Warren Buffett and Berkshire Hathaway, and for example, if you look at they've bought like 80 businesses over the last 50 years, there's probably at least 1/3 of them, maybe even 40% of them, that didn't turn out so well. And so if you weight it by dollars spent, the record is great. So they've been right on the big ones. But if you equal weight them all, the record wouldn't be great because there were a number of them. So Berkshire Hathaway, for example, bought a lot of retailers, a lot of furniture retailers and so on. Most of them have not worked out so well. So they had a lot of success with Borsheim's, which is a jeweler. They had a lot of success with Nebraska Furniture Mart. Subsequent to that, they bought a lot of other jewelers and other furniture operations. Most of them didn't do so well. Those are very tough businesses in general. Retail is tough. But if you look at Warren Buffett in certain areas, let's say, if you look at him on, let's say, levered institutions, banks, etc., almost no blemishes in the record. Close to 100% batting average. I think he had trouble. The only time he had trouble with banks was when he invested in Irish banks. But a few people got into trouble with that. But I think if I look at banking, for example, to the 50-year record, almost no blemishes. I mean, they almost hit it out of the park on that front. So I think that all of us as investors, or if I look at Warren Buffett in media, he's done really well historically, really good at media. He's done very good at consumer packaged goods, very good at brands, not so good at retailers, right, and such. So all of us have our, I would say, our circles of competence and where we are really good and where we might not be really good. And so one of the things that I'm trying to continue to learn is, where to go hunting and where to avoid. And so one of the things I've learned over the years is there's some miswiring in my brain that makes me miss the issues with levered institutions. So try to avoid going there. The other thing is, I think that in this business, the continuous learning, you start seeing patterns. And you can, many times you can connect dots that are not obvious to many other investors because they may not have seen all these different things play out. And sometimes when you can connect the dots in a manner that the market can't see, you can do really well with that because you can exploit inefficiencies there. So it's a journey, it's continuous learning, it's trying to figure out what to avoid and just keep the humility to know that 4 out of 10 times at a minimum you're going to be wrong and go from there.
Hi Mohnish, Will Sparks is my name from a company called Quilter, and I manage investments myself. My question is kind of out of the investment sphere. I mean, you're a big subscriber in the wisdom of Charlie Munger and Warren Buffett. What are the daily nuggets that you tell yourself every day that you've learned from the two of them?
Yeah, so I think that there are 2 or 3, I think, very big lessons to take away from them. So one of the biggest lessons, the most important trait to be a good investor is patience. And extreme patience, which is difficult for humans. So the interesting thing about equity markets is, if we look at our phones or look at screens, we've got flashing lights, red and green, and things are changing by the second and such. Real change in businesses takes years and sometimes decades. And changes in market prices of equities happens in seconds. And so the two are, in many ways, disconnected from each other. And so I think Fidelity the big brokerage house in the US, in the mutual fund shop, they had done a study. So they have a lot of clients who open accounts with them and then manage those accounts themselves. They buy and sell stocks themselves. So they studied all these accounts that people were running on their own to try to figure out which of their clients were really good investors. And so they found that there were a set of accounts which was sitting like in the top 10% performance of all the accounts. And the overwhelming number of the people who owned those accounts, they later found fell into one of two categories. Either they were dead, which means that they had the account and then they were no longer, there was no pulse, okay? And people forgot that this account was there and it just kept going, doing really well. Or they had forgotten they had the account. Okay, so the two best performing criteria was either you were dead or you'd forgotten. Okay, and so generally speaking, activity in investing is likely to hurt you more than help you. So I think the most, Charlie Munger mentions that he's been reading Barron's for 50 years. It's a weekly magazine in the US. And he read it from like the 1960s onwards. And in 2003, after 50 years of reading Barron's, he got a stock tip from Barron's. So each issue of Barron's has about probably 10 stock tips. And so you're getting about 50 issues a year. Over 50 years is 2,500 issues, 25,000 stock tips. Okay, so he goes through all the 25,000 stock tips, picks one. Okay, after 50 years, which was a company called Tenneco, auto parts and service centers and such. And in 3 years, so he puts $10 million into Tenneco in 2003. By 2006, it's worth 80 million, 8x in 3 years. And then he gives that 80 million to, for the first time in his life, an outside manager, Li Lu, investing in Chinese equities. And the 80 million is now, I think, sitting, I'm estimating, at around 800 million. So if you think about it, I can't think of more extreme patience where, 50 years, someone is throwing ideas at you, 10 a week, and you decide, no, I'm not interested, and then you finally get interested, and you actually really cream it, hit it out of the park. Cricket terms, hit a sixer out of the stadium, and then you do a 2-4, 8x and then a 10x. And he did that in 2003. He's 80 years old. So this is an 80-year-old. So if you think of Munger's track record in the last 16 years, it'd be in the top 1/10 or 1% or 1% globally. I don't know anyone else who's done 800x, 80x in this last 15 years. And so the willingness to wait for a really fat pitch is a very, very important trait. Almost equally important is sticking to circle of competence. So making sure that we're investing in things that we understand really well. There's a friend of Charlie Munger's, John Arriaga, and he's a billionaire, he's on the Forbes 400. And all John Arriaga has done in his entire career is invest in real estate within a mile of the Stanford University campus in Northern California, just around the campus, right? And that's all he's done. And so his circle of competence, what he understands, is not real estate. It's not even US real estate or California real estate or Northern California real estate. None of those things. It's actually just real estate within a very small geography. It's like someone understanding real estate within a mile of the Trinity campus. It's a pretty limited expertise. So the interesting thing about investing is that the size of your circle of competence is not that relevant in terms of how well you do. Sticking to it, being inside it, is critical, right? And so you don't need to know a lot of things to do well in investing, as long as you stick to the things that you know really well. And so I think those are I think some of the, and I'm, I think I could be better with patience. Like, I think Munger is the gold standard, that's what we should aspire to. And I think with even circle of competence, I think many times, if we have any doubt that we don't understand the business or we don't understand some nuance of the business, we should stay away. So those are, I think, important traits to try to get a good handle on.
I do have a question. I'm just wondering, for the students in the audience, do you have any particular advice when we start out in a career, maybe in investing or in any career, anything that you could nearly give us as we go out and start? Cheers.
Sure. Well, I mean, I think first of all, you already made a great choice coming to a great school, getting a great education at a great price, So on all fronts, you've hit it out of the park, which is really good. I mean, I think that one of the important things as you go into your careers is, if I were you, I would not take the highest job offer, or even the most blue chip employer that comes calling. What I think probably is more relevant than that is the people you would work for and work with. I think that is the most important criteria you should be looking for, is that, so the person if you're going to report to someone, it should be a person you like, admire, and trust. And the like, admire, trust, there's nothing in there about compensation, So don't focus on the compensation; it'll take care of itself. And but I think compromising. I think what I notice with a lot of people just entering the workforce is they get swayed by the big names. I mean, there are very good brand names, and if you tell people you work for them, or you tell people that you've got an offer for them, etc., obviously everyone will applaud that. But what actually really matters is going a couple of layers deeper into those places, to who you'd actually work for, and whether you think that the team and people you work for is what you would want to do. Another thing that I think what Buffett advises a lot of young people is that many times people will say that I'll do banking for 3 years, and then I'll go get an MBA, and then I'll start my business and this and that. So they have this kind of laid out plan, and he always says that's like saving sex for old age, not such a good idea. And so I think that basically, if you have goals, just go at them. Don't take this path because you don't really need to follow a path to get to your goals. So I think I would definitely encourage more kind of more direct approach towards getting to the end point you want to get to.
I host an investing podcast here in Ireland called Informed Decisions. You might not have heard of it.
Now I have.
I had the great pleasure of interviewing Guy Spear, your friend, on the 100th episode there last year, and super interview, super person, I think, as well as investor. I suppose for you, what does success look like for you? You're obviously very successful as an investor and as business, but is there more to it, or what's your legacy? I guess, if I can ask that broad question.
Yeah, so I don't tend to focus so much on that. I think my take is just put one foot in front of the other and keep going. So so one of the things is that, and this comes, I mean, part of this is, I think it's, you could say it's part of Buddhist philosophy or even part of in the Bhagavad Gita and in the Hindu scripts, is that we are not to focus on the reward. It is our duty to just focus on the effort and to give it the best effort. So the idea should be, the task at hand, really beyond not a particular endpoint and such. And I think the definitions of success can be very broad, and it's sometimes it catches you by surprise. I mean, I'll give you an example. Ronan had mentioned we have a family nonprofit called the Dakshina Foundation, and a couple of years back, my older daughter tattooed the logo of the foundation on her back. I can't think of a higher form of success for me personally, in the sense that, I mean, if your son or daughter is, tattooing an organization you created, they can't easily reverse that decision, and it has to have had some impact on them to do that, and such. So I wouldn't have defined it that way, but I was very happy to see that, obviously, and I would have never guessed she'd do that. I think for the longest time, we would have discussions where she would tell my wife and me that she's going to get a tattoo, and we would just always dissuade her going down that path. And then next thing you know, there's this tattoo, and this is what it is. So I think that there are many definitions. I think what I have focused on is that I like to play. I think if I look at my own psyche, I like to play mathematical games. Like I like to play bridge. A lot of investing has some math in it. So generally, I enjoy that. And one of the kind of what I would say interesting math games I'm playing over very long periods is I have one engine which is hopefully going to keep compounding wealth. And I have another engine which is trying to focus on giving it away optimally. And I want to end up, whenever I'm leaving planet Earth, that I'm at zero, where the two engines have matched. And of course, I think giving money away effectively is more difficult than making it. But for me, the game is fun. And there are some interesting side effects, people get helped and so on and so forth, which is fine. But the game is fun. So I don't focus on endpoints so much. I just say, let's just keep going. And as long as you sort of keep making some progress every day, Munger will say, try to go to sleep a little wiser than when you woke up, things will work out.
Hi, Mohnish. My name is Paul Neary. I'm an investment manager at Quilter as well. One thing that I have read about your philosophy is your fee structure and how, I suppose, aligned it is with the client. Could you tell us a little bit about that and I suppose why you chose that particular structure, and have you had any periods where it's been quite difficult as a result?
Oh, sure. Yeah, so, when I entered the investment business, I had never worked in the investment industry. So actually, I didn't even fully understand the industry. So I knew a bit about mutual funds, and I was aware of the Buffett partnerships in the 1950s, and I liked the rules that Warren Buffett had for his partnership. So I tried as much as possible to replicate them. In fact, what I did is when I was starting in '99. Roger Lowenstein had written one of the Buffett biographies. I photocopied a few pages of the biography. I took it to my lawyer. I said, read these pages and create this structure. That's basically what I told him to do, is because I just didn't exactly understand how to put it in place. And so to a large extent, I copied many of the Buffett rules and made them part of the rules of the PABRAI funds. And what I've learned between then and now is that that one of the things I've learned over the years is that cloning is a very powerful mental model. And the second thing I've learned, which is I still don't know exactly why this is the case, but humans are really bad at cloning. So what I repeatedly notice about humans is they'll see something great going on somewhere. And they'll even acknowledge, oh, that's wonderful. But they won't clone it. And so it is the inversion of that is that if you are a cloner, you get a huge advantage in life because the rest of humanity is not good at cloning. I see it repeatedly. The foundation we have, Dakshina Foundation, it works well because it's a clone model. I could never come up with that model, but I could copy it. The PABRAI funds fee structures and the way it's set up, I could never come up with it, but I could clone it. And I never realized how powerful that cloning was. So one of the things the Buffett partnerships did was Warren Buffett charged no management fee, and he only charged a performance fee. So he told his investors that the first 6% of returns every year go to them, and then above that, he gets 1/4 and they get 3/4. So for example, if the fund is up 10%, Buffett would get 1%. Whereas in let's say a normal 2 and 20 hedge fund, the fund is up 10%, well, 2% is already gone first to the investment manager, and then you're left with 8 and another 1.6 would go. So instead of 1% going to the manager in this particular example, it would be 3.6%. And if you have, just in terms of math, because when you get to these geometric series, if you have one investment with a manager who does 10% a year and keeps taking 1%, and another investment with another manager who does 10% a year and keeps taking 3.6%, the delta in those two after 30 years is not going to be 20 or 30%. It may be 80 or 90%. There'd be a massive difference because the power of compounding, you'd be compounding lower numbers, a significantly lower number over time. So the zero fee structure that Buffett used, I cloned it because I thought that sounds very fair. And it took me a few years to realize, probably like more than 4 or 5 years to realize that not only was it a very fair structure, but it gave me a competitive advantage that hardly any competitors could copy. And so the interesting thing is, so what happens in most investment shops is that they are set up with a 1 and 20 or 2 and 20, or if there's a mutual fund, 1% fee or whatever else. And if you have, for example, $100 million under management, and you have a 2 and 20 structure, for example, you're guaranteed to get in about $2 million a year. And what a lot of these investment shops will then do is they'll have teams of people because they can afford to have 1 or even 1.5 million of payroll, and that's covered. The zero fee structure means that you could easily have 1 or more years where there is no revenue to the firm. If I'm up 4% in a year, there's no revenue. It's zero. There are some expenses, but there's no revenue. And so the second part of what this fee structure enables, which is also part of the Buffett and Munger system, is investment teams are an oxymoron. So value investing is not a team sport. It is an individual pursuit, and it should be an individual pursuit. And so when you start having teams of people, generally speaking, the results will suffer. So like I think like John Bogle used to say that in investing you get what you don't pay for. Okay, so the bottom line is that this is it's a very bizarre industry. It's one of the only industries where 80% of the participants in the industry add no value. You know, they subtract value. So the industry would be better off if it was smaller, if there were fewer people in it. And so the rules I copied from Buffett Partnership, one of those was the zero fee structure, the 0-6-25. And as it happened with PABRAI funds is that we had no down years from 99 to 2007. It was just straight up. In fact, I think before fees we did kind of mid 30% a year. So even after fees we were doing high 20s a year. And then when the financial crisis hit, the funds got hit pretty hard. We were down, one of the funds were down 70%. So pretty significant drawdown, which meant that for me to collect a fee, I had to first come up to par and then the 6% a year for as long as it took to get up. And in one of the funds that I run, it took 10 years. So I collected a fee in 2007 in that fund, and the next time I collected a fee was 2017. But that was the covenant I had with my investors, so it never crossed my mind that I should shut down and restart. I think that's kind of unethical. And I didn't also, neither did I go to them to change the terms. So we kept to those terms. And but the thing is that you know, this is a business with some spectacular economics. So if I am, for example, managing 500 million, and for example, if I'm up 20% in a year, my fee would be 3.5%, which is, you know, sort of like almost $17 million. And at PABRAI funds, there are no full-time employees other than me. Because, you know, I already told you, a team is an oxymoron. And so it's a business where there isn't much expense. And so almost all of that 17 million would drop to the bottom line. You know, maybe we'd have $500,000 or something in expenses. So the thing is that when it works really well. And if you made 17 million 1 year, well, you can have a few lean years, you know. So I don't have any complaints about the structure or any of that. And I think it's very fair. I think it's worked out very well, and no issues. So but also the interesting thing about this fee structure is I interact with a lot of young managers, and they'll come to me and ask me, you know, I'm setting up a fund and blah, blah. And I know at the back of my mind, humans are terrible at cloning. So I play a game with them, right? Now that they'll see it on video, it'll all be over. So sad. Okay. And so I'll tell them, you know, 0 fees and, you know, no team, blah, blah. I'll give them all the pointers of what to do. And then I just sit back and observe what actually happens. No one does 0 fee. And no one does no team. It's like they listen from here, it's out here, and yeah, whatever. And I even try to explain to them why it's a competitive advantage and why it's worked for me and so on and so forth. And they can see that it works. But still, because cloning is not part of the human genetic framework, they can't handle it. And so I have to sit here with my competitive advantage unblemished, which is fine. So such is life.
Yeah, so I love the Buffett partnership model. I've actually seen that in the past as well. I think it aligns incentives perfectly, which is good. But just on a side there, so you managed your own business and you sold that business, so you weren't if you lost money the first year, you could probably survive. I don't know what commitments you had between housing and family, etc. But if you weren't financially at that stage, could someone do that, or do you have to have some?
Yeah, so actually I started PABRAI funds before I sold my business. So, so what had happened before I started PABRAI funds was in '94, I had sold a small portion of my business, and after taxes, everything, I had $1 million. And by the time I started PABRAI funds, that 1 million was sitting at 12 million. I'd average about 70% a year. Well done. Never to be repeated after that. So Charlie Munger says that why should you give your money to an investment manager who is not already wealthy? And if they are any good at investing, once they're in their 40s, they should already be wealthy. And actually, that is a very true statement, because if you are working someplace and you're saving some part of your money and you're compounding at ridiculous rates with small sums, which you should be able to do if you're a great investor, 40% a year at small sums, that will add up very fast. And so the thing is that one should not need the 1% fee. And the second reason I tell these young managers why the 1% fee is a stupid thing to focus on is they don't have assets. So I said, you've got like 2 million in assets, and I'm asking you not to charge the fee. You want to charge a 1% fee, that's $20,000. That's fine. It'll pay for your Starbucks coffee, and maybe not that much else beyond that. So it's anyway not going to help you make ends meet. But what it will do, it'll make it more difficult to raise money. And also what it will do is make you sleep slightly less well at night, because you're somewhat out of alignment with the universe. So I think that it is an issue that there's some chicken and egg involved. But to give the example of, let's say, Li Lu, who manages Charlie Munger's money. So Li Lu, he was at Tiananmen Square, and the Chinese government wanted to get their hands on him, and he escaped with some help to Hong Kong, and then finally made his way to Colombia. And when he arrived in the US, he had an undergraduate degree from China, but he spoke no English. And I think the only guy at Columbia who did 3 simultaneous degrees at the same time, an undergraduate degree and an MBA and a law degree all at the same time. And while he was in school, as he was getting these student loans, he kept investing that money, and I think he graduated with $250,000. Okay, so this guy comes from China with no English skills of any kind, and 3 degrees at the same time, and doing investing on the side as well, and using his student loan money, and he's multiplied that, and he just went from there. So and I asked Charlie, why did you give your money to Li Lu? He said it was obvious. There was nobody else. It wasn't like I had 5 choices. He said it was just obvious. I just looked at the track record, and it was pretty easy to go there. There was a friend of mine in high school, Desmond D'Souza. 2% of Indians are Catholic. And so Desmond, kind of a below average student you would hardly ever notice in class, one of those backbenchers. So he came to the US for his undergraduate degree, came to New York, and his parents, he and I both finished high school in Dubai. And so most of us were leaving to go to places which had colleges. And so when he was coming to the US, to New York, to study, his parents basically said, look, here's 4 years of living expenses and tuition. We're putting it in your account. We trust you. And don't bother us for money for the next 4 years. We're done with your education expenses, right? So he had a decent amount of money that he was sitting on. And without telling his parents, he bought this single-family home right across from campus in New York. I don't know, 5-bedroom home or something. And he filled every nook and cranny of that home with students. I think there were like 6 of them in the living room. Okay, I mean, he had like 40 people living there, and he was the slumlord, collecting rent, right? And of course, he had borrowed 80-90% of the purchase price from a bank, and in a few years, I think in a couple of years, the prices had gone up. I think they've gone up like 20% or something. So he pulled equity out, bought 2 more homes, and filled those up with students as well. And then after that, he got to know this. I was studying engineering. I was in the top 1% of my class. I remember I visited Desmond in New York just right after I had graduated. I thought that I'd done well and I'd gotten a nice job, etc. And Desmond is telling me he's got no interest in taking any jobs. He thinks that's like for losers, He's telling me that. And what he did when he graduated, he made friends with this banker, and there was this neighborhood, this Haitian neighborhood in Long Island. So the banker told him, listen, so Desmond asked him, listen, instead of buying regular homes, I want to buy foreclosed homes because, those are beat up and nobody wants to buy them. And so the banker told him, listen, I can actually give you a great deal if you take 20 of them. He had all these, and these foreclosed homes in the US, I'm not sure what happens in Ireland, but when these guys are leaving the house, even the plug sockets are gone. I mean, the appliances are gone, the home's destroyed, for all practical purposes. So no woman's going to go in and say, this is the one I want, And so Desmond buys these 20 foreclosed homes, and he has this whole crew of contractors who immediately go in to fix everything, change the appliances. And then he used actually the same people who were fixing his homes, all these Haitian contractors who were all renting apartments, and he convinced the same banker to give them loans to buy the homes that the banker had given him on foreclosure at a significantly higher price. And he told the Haitians, basically, bring me all your uncles and cousins and everyone else. I'll get them all into homes, right? And he convinced, and so all these people, he's getting them homes, were black, right? And they'd face some discrimination with bankers, etc. So Desmond sat down with his banker and said, look, these are hardworking people. They've got skills, they've got income, they've got everything. Don't mess with them. And let's get them through the pipeline. And the banker was happy. He said, yeah, they fit all my profiles, and I'm happy. So he had this whole engine going, right? I mean, he's buying from the bank, foreclosed. Within about 6 weeks, the property is all done. In another month, he sold it back to the same bank, and just on and on. And Desmond, a few years is worth a few $1 million. No job. And never had any great GPA in college, and didn't care. So I think that what I'm saying is that the bottom line is that, if you've got the skills of a good investor, I think you can generate the capital. It might take some chutzpah, if you will.
More question. You talked about being the only player in PABRAI funds. There's been a lot of talk of Berkshire Hathaway, correct me if I'm wrong, who's like Warren Buffett's successor, Gregor, Abel, and Ajit Jan. Do you have any ideas? Are you going to have a successor in PABRAI funds when the day comes or whatever, or would you wind it up straight away, or what? Do you have any thoughts on that?
Not designed. In fact, in the fund documents we've written that if I get mentally disabled or I pass away, whatever, it's designed to liquidate. So these are really not, I would say they're not designed to be sustaining enterprises. Even Buffett put his, ended his partnership. So I have not at this point thought about, any type of a continuation, if you will. So it's designed, because I think the investors have made a bet on the investment manager. And I think in any case, even if we tried to, if I told my investors, by the way, I'm retiring and here's John Smith who's going to be taking my place, I don't know how many of them will stick around, so.
Hi, MOHNISH. My name is Connor. I'm an accountant and I recently started my own business. I was wondering, you said earlier that it was maybe a little bit more difficult to give money away effectively than it is to make money. And I was wondering, what principles you might be following in the Dakshana Foundation that might be making it a little bit easier, or how are you giving away the money via the foundation?
Yeah, that's a good question. So I think that what we try to do when we are entrepreneurs or trying to build businesses is, contrary to what people think, is entrepreneurs try really hard to minimize risk. So they look for offering gaps, and they look for sure bets as much as they can. I'm talking of non-venture backed businesses. So for example, there's a new town coming up, let's say 20 kilometers from Dublin. There's no barbers there. A barber in Dublin might open up a small shop and go there 2 days a week, and then gradually build up from there, that sort of thing. So most entrepreneurs look for opportunities and minimize the risk. When we are trying to give money away, so again, the other thing entrepreneurs do is they look for the best opportunities. They look at all that kind of range of things you could do. If you look at something like what Desmond did, he didn't have much risk. He bought a home. He was pretty sure he could get the students to rent it because he himself was renting and such. If it didn't work out, he could have sold the home. It wouldn't have been much of a loss, and so on and so forth. So he just didn't have much downside. And he could pick what area he wants to go into. He didn't go and buy a commercial office building or anything like that. When you go into charity and philanthropy, you've got like a few choices. Deal with poverty, drug abuse, alcoholism, homelessness. You're dealing with core problems, early childhood education, all kinds of things. So you're dealing with problems that government spending billions of dollars have had difficulty dealing with, and a lot of other humans for a lot of decades have had difficulty dealing with. So these are not easy problems. These are difficult problems. And you don't get to choose so much because there's just 5 or 6 choices, and they're all problems because no one's been able to solve them in the past. So take your choice, And so the rules for philanthropy are different. So one of the rules for philanthropy is you have to swing for the fences. So when we are an entrepreneur, we try to minimize risk. When we go into charity, we have to go extreme risk. So we have to say, I will try extreme stuff to try to get a different outcome. I will not, and I'm willing to lose all the money I'm putting in to try to get that. So if you take a very safe approach in charity, it's very likely to fail because a lot of safe approaches in the past have been tried. So you have to think outside the box, and you also have to be very willing. So I would say, like, if you look at the Gates Foundation, for example, they spend a lot of money on vaccines, developing vaccines. Vaccines is high risk, high return. Most of what they've been doing for more than a decade or 2 has not worked. But they know that there are moonshots, right? You get one to work, you get polio to work and has a huge impact on humanity. You get malaria to work, huge impact on humanity. And so those are like, if they're working on a malaria vaccine, it could be $1 billion bet. and it could be nothing happens, it doesn't work. But it's worth making that bet. That's a great bet to make. So I think that in philanthropy, we have to go high risk, high return, and we have to be very willing to fail. And so it's, in many ways, it's the opposite of both value investing and entrepreneurship, because in both those cases, we try to reduce downside. And we don't go for moonshots. We just try to get singles, if you will. And so that's the difference and I think the problem a lot of charities have is that the third issue is that, so let's say I open a barber shop, right? And I provide terrible haircuts, okay? I won't be around for very long, okay? The shop's gonna close down. Or if I open a coffee shop and the coffee is not so great, it's not gonna be around for it. I mean, capitalism is a feedback loop, and it's pretty quick and brutal, and all the riffraff businesses are gone, right? And what we're left with are the guys who can actually deliver. If I have, let's say, the Rockefeller Foundation or the Ford Foundation, and let's say I've got $1 billion endowment, $1 billion, sitting in my bank account, and I'm spending 5% a year. Whatever I have, I spend 5% a year, which is the US law for foundations. So I have $1 billion in the account, I spend $50 million a year. It doesn't matter what kind of haircuts I provide, okay? I'm never going out of business, okay? So that the problem that charities have is they have no feedback loop that forces change. The end result is useless work done by charities. And what I always find, which is the problem I have with a lot of charities, is to do it well, you need a combination of heart and head. You need to have heart, but you also need to have head. You need to basically, I always tell my staff at Dakshina, we are not a charity. We are a business. And the only difference between us and any other business is we don't have a profit motive, but we have very tight measurements of outcomes that we have to make. So one of the things that Dakshina decided to write at the beginning is because the lack of a feedback loop for charities is a real serious problem, because in entrepreneurship, it's just naturally taken care of. So most charitable ventures that you would engage in have no feedback loop. So let's say, for example, in San Francisco, there's a large homeless population. And let's say I decide this is terrible, I want to give blankets to the homeless, for example. So I buy a bunch of blankets and I distribute them. And every few weeks I go out and see who's missing blankets and I give them blankets. Let's say that's my charitable endeavor. That's really good. So how do you measure the outcome? I mean, what would you use as a measure to tell you that this is great? Or how would you measure that it is the best use that you could have had of that money? So for example, let's say someone else said that instead of giving blankets to the homeless, I'm going to get homeless off the streets, right? And they create housing, and they take some homeless folks and they move them into that housing. So you could say, for example, that, okay, this year I moved 10 homeless people into, off the street. But one of the problems we run into is, what if because of the 10 people moving into housing, 50 more move into the city as homeless? Because they know San Francisco provides great services to the homeless. So just attract more people coming in. So the problem is that it's very hard to answer these questions. It's very hard to answer the question, is it better to give the guy, one person, a home versus 5,000 blankets? Which is better? I don't know which is better. I have no idea. So what I did with Dakshina was I inverted the problem. So Munger always says, invert, always invert. So the inversion of the problem Dakshina did is we will not engage in any charitable activity which cannot be measured. So I looked at the range of charitable activities, and 99% cannot be measured. I just threw them away. Okay, and we focused on a sliver where there's a very tight feedback loop. And lo and behold, Dakshina works really well because we continuously get the feedback just like a business, and that feedback tells us exactly how well or poorly we're doing. And all of that works because we applied inversion. So these are some of the things I've learned about charities. Of course, it doesn't solve humanity's problem because I'm not dealing with 99%. And there's a lot of other charities dealing with stuff which cannot be measured. Maybe they're doing a good job, but we just can't tell. You know, it just becomes really hard to tell.
Hello, sir. My name is Shu Hang, and I'm currently a second-year business student. If my memory is correct, you used to mention that it might be a good idea to invest on those companies who can maintain themselves unrisky, even when there's a huge level of fluctuation and uncertainty in financial markets. So I'm wondering if there's any specific aspects or indicators you will look at or especially emphasize when trying to identify those companies.
Yeah, so I'm not sure I exactly got your question, but one of the things I do focus on is the nuance of low risk and high uncertainty. Is that what you were asking?
Yeah.
Yeah. So basically, the thing is that stock markets hate uncertainty. So what they want is you produced $1 in earnings this year. Please produce $1.10 next year, $1.20 2 years from now, $1.35 3 years from now, and please go nonstop like that. Okay? And the reality is that the business world is very messy. It just doesn't work that way. You know, things just don't go in a straight line, and they go up and down and such. So stock markets have, in my opinion, a irrational, extreme expectation of smoothness in business operations, and almost any business is anything but smooth. And so if a business has a temporary hiccup, you know, they just say, hey, by the way, next quarter might be slightly off, taken out back and shot. First, let's take it out back and shoot it, then we'll ask questions, okay? And you know, Buffett had mentioned that when he was buying the Washington Post, I think he was the market cap of the company was around $80 million. And he said in any private transaction then, it would have sold for $400 million. So it was sitting at about 1/5 of liquidation value or the sale of a private, what a private buyer would pay. And the 80 million market cap went down to 60 million because people just kept selling the stock. And the sellers, and Warren knew some of the sellers, they agreed with him that the private market value was 400 million. But they just didn't want to deal with the near-term uncertainty that the business was facing. So if you have a business which exhibits very high uncertainty, then that business generally will get very extreme kind of valuations in a auction-driven market, and an investor can take advantage of it because markets get confused between risk and uncertainty. They get confused between these two, and to give you an example, I had made an investment a few years back. I think this was like in 2004 or so, maybe it's been 14, 15 years. There was a steel company in Canada called IPSCO. And the nuances of this company were as follows, that the stock was trading at $45 a share. The company had no debt. It had $15 in cash. And it had contracted revenues and certainty of earnings and cash flows for the next 2 years, which were $15 a share each. So the company would make after tax $15 in each of the next 2 years. So in effect, I was paying $45, and if I just held the stock for 2 years, I would have $45 sitting in the company. But I would still have all the plants and everything else. But the business was extremely volatile with extreme cyclicality. So after 2 years, there was no certainty of any kind of what earnings were going to be. Wide range, unknown. And markets don't like that. So what did the market do? It priced it at 45. And from my perspective, I said, okay, why don't we just buy the stock and wait for 2 years? And because I have all the plants, I have everything else, I just want to see what happens after that, because doesn't look like they have too much downside. And so we bought at 45. A year later, the company announced that they had 1 more year of visibility. They want to have another year of $15 in earnings. So now we were in the money, and the stock went to $65 because we now had, in effect, $60 coming in. And then in a few months, it drifted close to $90 because I think markets probably started realizing this is ridiculous because you're not giving any value to the plants and all of that. And some Swedish firm came and offered $160 for the business. And the stock immediately went for to 153 or something. I didn't even wait for the deal to close. We were out of there. And I still don't understand why that Swedish firm didn't come and buy them 2 years earlier. But that's the way it is in life. Like Mark Twain says, truth is stranger than fiction because fiction has to make sense. So uncertainty really bothers markets. There was another company I had invested in, I think this was about 4 years ago in India, called Rain Industries. And this company had borrowed a lot of money, bought plants, taken on a lot of debt. And all those plants, everything else they bought, was barely able to cover the debt service. They weren't really contributing to earnings. And so the market gave no value to like 90% of the assets of the business. So $2 billion in revenue, 200 million market cap, those plants had cyclicality in them, and we were kind of close to hitting bottoms on the cyclicality. If they got to somewhat normal environments, the company could be producing 200 million a year in annual cash flows, and I was paying 200 million for the entire business. And so we bought the stock, and for 2 years it just went straight down. It didn't do anything. The 200 million market cap went to like 160 million. And then in the third year, the earnings came in. They came in at 200 million, and the market cap went to 2 billion. And then now recently again, they hit a patch in their earnings, so it corrected backwards. I think we have like a 2.5 times gain, but we had a 12 times gain at the peak. So the risk and uncertainty is a very interesting thing to have in your toolbox, because equity markets and especially auction-driven markets hate uncertainty, and especially there can be businesses where the uncertainty is only for 6 months or only for 9 months, and markets will punish them for that, and so that can give you an edge.
Hi, Tony O'Sullivan. I'm a European banks analyst at an independent company called Carrickhill. It's kind of related to the previous question, but thinking about, say, Ben Graham, and markets are there to serve you, not to guide you. Throughout your career, what tools have helped you when, say, stocks you own are going down in value, it's our ticker value is going down, market prices, but you inherently think the company is intrinsically valued far above the market price. What tools help you as an investor to stay the course and to not allow markets guide you?
Sure. So, Tony, it was great to see you in Omaha. Yeah. Hopefully, we'll see you again.
Likewise. 2016 in person.
So, I'll tell you a little story. My dad was an entrepreneur who went bankrupt many times over his career, and he was really good at starting from scratch again. It was amazing how many times he would usually his biggest flaw was too much leverage, and then things would blow up, but then he would find some new idea and get going again. And and my parents were very bad financial planners, so there really wasn't any savings or anything. So business went down means we had difficulty making rent and groceries and so on. So I think I was like 11 or 12 years old, and my father had just gone bankrupt, and the business had gone under. And every Sunday there was this guy in orange robes with all these marks on his forehead coming to our house, and he was an astrologer. And my father was consulting him about the future. What's the future going to be? And my dad was a very rational engineer, So I went to my dad and said, you have to know that everything this guy is telling you is total nonsense. You have to know that. So my dad says to me that I'm at the bottom of a well, and I need a rope to come out of the bottom of the well. And when I pay this guy to tell me about the future, he knows that he's not coming back next week unless the forecast is really rosy. Okay, so it has to be an exuberant future. And he also knows that the more rosy it is, the slightly higher he might get paid. So every week when I call him, he paints this picture: you're going to start another business, it's going to do really well, blah, 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 and I'm gradually coming out of the well, right? So that's how my dad explained this to me, right? And so let's say like the financial crisis, when I was down 70%, for example, I thought about my dad, and I thought about that astrologer, and I didn't have his email address. Damn, that's who I needed then, Tell me what the performance is going to be, and I'll pay you, and I'll pay you more if it's going to be more, And but I couldn't find his email address. So I had to come up with my own rope to come out of the well. And so what I did was, one of my rules of investing is thou shalt not use Excel. But I said, let's violate that rule to come out of the well, because coming out of the well is more important than Excel. So I created an Excel spreadsheet which had my portfolio with the current prices. And then I put down the price at the end of 2009 or end of 2010, 2011. And all those future prices were much higher than the current price. And then I looked at the value of the portfolio at those times. Those numbers looked really good. And that was the rope. And so we all need ropes to come out of deep wells. And I don't have the guy's email address. So you need to find your own rope, in effect. But I think that the nature of equity markets is that we are going to find ourselves. things, we buy things that are cheap, we understand the business, that's all fine, they get cheaper. And they can be cheaper because you made a mistake, or they can be cheaper because it makes no sense. The markets are mispricing it even more. And until we figure it out, we need some rope to, it would be a mistake to sell things just because they become cheaper. I think you can sell things if they're cheaper if you're convinced that the current value of the business is below where it's currently trading. But if you're not convinced of that, you're better off being like the Fidelity dead clients and doing nothing. So everyone needs a rope.
My name is John Carney. I'm in the life and pensions business here in Dublin. Just want to ask you, are you fully invested presently, your fund?
We aren't fully invested, but we don't have that much. We don't have that much cash. I think less than 10% cash.
How do you feel, for the future? Do you think the markets have a bit to go still? Like I see in some of your earlier slides, the Dow and the S&P, like their bull runs they started, I think, 7 and 8 years, 17 years.
Yeah, so
the bull runs are getting longer.
I think the thing is that I almost never, so like I told you, the presentation I made is a kind of weird presentation because I almost never have a view on the markets. And even now, so if I look at the US markets, I actually don't know exactly where they're going or what they're going to do. What I do know is I find it hard to find stuff. And in fact, we have not had an investment in the US for 4 years. I used to be 100% US. And the last 4 years, I found one stock to buy in the US. So my portfolio allocations became really strange. And it's not because I have a macro view of anything. It's just we found stuff in other geographies. So I generally feel that at least the US markets are either fully priced or may even possibly be overpriced. But that doesn't mean they're going to correct. They could grow into that. We have no idea of all that. I do believe that there are other hunting grounds that are better. We've done a few investments in India in the last few years. I think those are better than what we could have done in the US. I'm going to poke around in Korea a little bit more. I don't know whether we can actually get to, for me, the biggest issue with Korea is circle of competence. So I don't know if I'll be able to cross that and actually be able to convince myself that I really understand this. But if we can, we'll see. If we can, we can do that. Like, if I'm looking at something which is like the Moody's of Korea or credit rating agency or something, I might be able to get my arms around that. So we'll see. But yeah, so I think the way I look at it is I try not to have views on markets or macro or anything, because I think generally speaking that's a really hard game. It's a really hard game for me. I think it's just better to just look at individual businesses and go from there. But then you probably have the problem of a huge amount of assets, and it becomes hard to put it to work in a few names. So, yeah.
Hi, Mohnish, thanks. Yeah, I'm a backbencher like Desmond maybe, but it was just
you're already halfway there, man. That's great.
Thanks. I was wondering, how do you manage yourself on a day-to-day basis, and what's your kind of routine like, I suppose, from day to day, and how you look after yourself?
Yeah, so I take a nap every afternoon. So afternoon naps are good. I actually have a nap room off my office, which is nice. So yeah, so actually what I try to do, and these are all things I've tried to pick up from Warren and Charlie, is I try not to put anything on my calendar. So in a typical week, I don't have anything on the calendar. I don't set up meetings, and and such. And what I want is that every day there is reasonably large chunks of time available to read, and to read in a wide range of things. So sometimes I may have a particular investment I'm looking at, and I might be drilling down on that. Other times I might be reading a book. I read a few newspapers every day, and so on. So the key is to try to not have a lot of kind of obligations and such, but to really have a kind of open calendar, and then take it from there. Like, I think my assistant told me that somebody wanted to do some kind of podcast, and I just told her, find a week where there's nothing going on, there's nothing on the calendar, and we'll put it in then, and whenever that is. And so I think that's the key. At least what I found useful is not to clutter things too much. And in the investing business, if you can find 2 or 3 things in a year, I think you're doing pretty well. And it's a great business because you get to spend your time thinking about all kinds of things, which is great, and reading all kinds of things, which is also great. But thank you very much, and thanks for the wonderful hospitality and hosting me, and I wish you all the best. Thank you.